This video, we're going to talk about the accrual accounting concepts. Now, what does that mean? At the end of every period, we need to adjust the statements for some things that have happened and have not been recorded yet, or things that have been recorded but haven't quite happened yet. So we have to make some adjustments. So we're going to talk about this process. If you remember, we had this idea of the periodicity assumption that said we break things into months, quarters, and years. But of course, there are things that carry over from one month to another. If you remember, we need to match revenues to the month in which they happen and expenses in the period in which they are used to create the revenues. So the accrual-based accounting, basically we have transactions been recorded in periods where the events have occurred, but maybe cash has not traded yet. So we could have revenues. We did the service, but we haven't received cash. For expenses, we actually had something happen, right? We used something, but yet we haven't paid cash yet. We need to bring those two concepts and reconcile them at the end of the period. So here we have this, and I can't say this word, periodicity assumption. Basically says there's economic life. There's revenues that happen, they've been obligated, there's been expenses that have happened, and we have to recognize them. So we recognize these revenues and expenses under the GAAP rule. So here's a little example. We're a dry cleaner. We clean some clothes for $500, but we send a bill to our customer, and they don't claim and pay for their clothes until the very first week of July. So we've done the work, but we haven't been paid. So what do? We show the service revenue, and we also show them the accounts receivable, right? Again, remember this equal sign. On each side if you're on opposite sides of the equal sign, they have to be the same sign. Now, at the end of July, the customers give us the $500 that they owed us in this accounts receivable. So again, that's essentially what we're going to do at the end of the year, at the end of the period, when the event actually, the cash transfers, that's when we're going to, again, make a record. So some things will always have two transactions. One to show the event and a debt, and then the other one to show the unwinding of that event. So cash basis accounting is when we recognize only when cash is received, and expenses are recognized only when cash is paid. This is a simple process, but it is not a GAAP process, right? So it's not generally accepted accounting principles to account for business with cash. So who is going to do this? This is only going to be done in very small businesses. Most cash businesses are entrepreneurs, typically that work for themselves, and they usually don't have employees. So this is the type of business that might be a cash business. So how this works, if you think about it, in 2021 here, we purchased paint, we painted a building, we paid employees. So I have revenue of $80,000, expenses were $50,000, so the profit for the year was $30,000. So what happened then? If you think of the cash basis, we didn't mention anything here about getting paid. So we have zero revenue we have the expenses. So in the end, we have what? We have a negative $50,000 is the cash loss. In 2022, what happened? There was no revenue, there was no expenses, zero income. So what? A total of what? $30,000 total. What happened here? Now we receive the $80,000. There's no expenses. So that means in this year, there's $80,000 of cash flow. Now, if you add those together, what do you notice? 80,000 plus a negative 50 is 30. Add those two 30. So in the end, you get the same values, the same totals, but yet it's represented in different years. That's really the difference between accrual and cash basis accounting. I have to think that when this company painted this building, right? I'm sure they wrote that down somewhere. They made a journal entry somewhere that showed that these people owed them money. Over here, they're going to unwind that when they actually receive the cash. So in the end, what we're looking for here is we need to make some adjustments, right? We need to make sure that revenue recognition and expense recognition principles are followed. This is going to happen every time we make a financial statement. We're going to have to adjust it, if you will. And typically, there's always one income statement account and one balance sheet account that gets adjusted. So let's think about what types of adjustments we could have. We have prepaid expenses and unearned revenues. This is what we refer to as deferrals, right? Something is put off to the end. The cash is off to the end, or the expense is off to the end. Accruals, we can have accrued revenues. This is where we perform the service, but we didn't have the cash yet. And accrued expenses, the expense has incurred, but yet we haven't paid it in cash yet. So we have to adjust for that. The cost or revenues that are recognized at a date later than the point when cash was originally exchanged. This is what we're referring to as a deferral. So we're going to have to record expenses. We're going to have to record revenues that have actually happened during the period. So we're going to have to come back and, again, I keep saying this, we're going to have to adjust for that. So what are some of the prepaid expenses? The things that we kind of think of: insurance, supplies, advertising, rent. Maybe you pay rent in a business, you might pay rent by the quarter, right? So you use it up every month. So when you do monthly statements, you're going to have to adjust the rent expense every month to show that that rent is expensed in that particular month. So here's our statements that we had started before, right? We've used these statements before. So we want to see how the adjustments might get done. So let's think about it. So we had bought some supplies for $2,500. At the end of the month, we do inventory. There's only $1,000 of inventory still on hand. So we need to say, again, remember, there's $2,500 of inventory here. We need to show that there's only $1,000 left. So we need to subtract 1,500. And again, if we go across the sign, that's an expense. So we're going to have to write off then that $1,500 as supplies expense. So we paid $600 for 1 year fire insurance. Well, 600 divided by 12, that means every month there's going to be a $50 expense. But what we did here, remember, we have prepaid insurance. We wrote off we paid the cash, and we recognized this as a prepaid insurance. So at the end of this month, we need to deduct $50 from that. So we deduct $50 from the asset. And again, that shows over here as insurance expense as a negative number. Sorry. So that's the first part of this. This is a two-part video because there's lots of these examples to look at. So I look forward to seeing you in the next video.